Time now for Money Manager. In the studio with me is Portfolio Manager at PSG, and that's Shaun Le Roux. We're going to talk about the PSG Equity Fund. Equities, Shaun, are obviously in focus all the time, but we've had a very volatile first quarter. We're just in the early stages of the second quarter. US earnings season coming up, markets looking potentially vulnerable, but your fund did well last year.
We had a decent year, and we were most pleased with the outcome, given that we weren't heavily exposed to some of the high flyers, the Naspers, Aspens of the world. So we think we achieved good results, but probably most importantly at lower risk than a lot of the funds were taking.
So more conservative. And when you look back at the names that you've just mentioned, do you say to yourself, goodness me, I wish I was a little bit more glamorous with my predictions for markets and went with momentum rather than the conservative approach that you've taken?
Hindsight's always a wonderful thing.
Yes.
They're great. We think you have to differentiate between a great business and a great investment. So if we're talking those kind of names, they're companies that we've owned in the past. We had significant positions in something like a Naspers, but when the price was right. And what that means in our lives is when we think that margin of safety is sufficient. So we felt for some time that we can find companies that offer better long-term returns at significantly lower risk, and a lot of the stocks we own have done very well. So we've been happy to play in other parts of the market.
If you look back at the late 1990s and up until March 2000, of course, Warren Buffett famously didn't own a dot-com stock. He didn't understand it. The valuations were too high, and everyone was sort of poo-pooing him and saying, "Well, look, finally we've got a crack in your reputation here." But then, for the next 2 years, he looked like gold. And I suppose the same applies here. At some stage, these high flyers are going to be low flyers.
Yeah, it's very difficult to predict what's going to happen, and to be honest, we spend no time trying to do that. What we're looking at is looking at a universe of investable opportunities and trying to select the best opportunities that are available at any point in time. When a story builds around a sector or particular stocks, and the expectations baked into that stock means that they're essentially priced for perfection. At some stage, if they come up short, there's a long way to fall. And for us, risk is about basically, not ever losing capital for your clients or trying to remove that possibility as much as possible. And hence, we would tend to step away, when stocks get into these kind of territories and when that story is so pervasive.
You've got around about 2.3 billion under management in this particular fund. How much of it is in equities? What's your percentage exposure at the moment?
It's an equity fund, and we tend to be fully invested in equities, but of that 25% is in direct offshore equities. So at PSG Asset Management, we run a full global investment process. So the same team picks equities on both a local and a global basis.
Yeah. What are you seeing overseas at the moment before we get to South Africa? Because we've got US earnings season around about in a few hours' time is going to kick off with Alcoa. A lot of people saying that Europe is starting to outperform, US is starting to underperform, Japan going to fresh 15-year high this morning, Chinese stocks going through the roof. So lots of different forces. Must be a difficult job for you.
Yeah, look, for us it's a stock by stock story. So we're not investing on the basis of some kind of theme or a macro investment into a particular geography. We're of the view that if you do have a global universe, there you have the ability to play in a bigger pond, and typically there are a lot more opportunities. But just like is the case domestically, the reality is there are a lot fewer opportunities, or we're finding a lot fewer opportunities today than we were a few years ago. And the stocks we own, that gap between price and what we think they're worth has narrowed. So the consequence is that the returns over the medium to longer term are going to be lower than they were a few years ago.
So you won't say to yourself, I think that the US is slowing down, therefore I'm going to avoid that particular geography. I think Japan has still got some momentum. So it'll be a case-by-case, company-specific investment approach.
100%. So we would be using the macro environment as a framework, but particularly to frame the risk. So we'd be looking at the companies we own, and we're saying, is the margin of safety adequate that if the dollar were to strengthen or weaken or rates to go up faster than people assume, we're more than compensated in terms of what we're paying, price versus value.
Yeah.
So it's very much a bottom-up basis, but we are mindful of what is happening in the world. We can't ignore that.
No, you can't. I mean, it screams at you every single day these days. Let's talk about your top 10 equity holdings. Number 1, Glencore Xstrata PLC. Interesting. I mean, the JSE's resources index has done very well today, so it's probably a nice day for Glencore. But it's been a dodgy sector for a while.
Yeah, mining companies have had a torrid time, and we don't claim that a mining business is the greatest business around, but we think there are times where they become very good investments. And we think we're moving into such a time. Commodity prices have collapsed, and as a result, earnings have collapsed. But at the same time, valuations are very, very low. So we think that if you select carefully within a sector that has been decimated, and you pick the best players, the miners that are operating low on the cost curve, that have got strong balance sheets, that are going to generate a lot of cash, and in the case of Glencore, most importantly, have an ability to invest in a contra-cyclical basis. They're out there buying other mining businesses that are on their knees, and you're partnering with a management team that's got a lot of equity in the business. Looking 5 to 10 years down the line, we don't think that's a bad place to be. And it's one of the parts of the market where we would still see substantial upside.
It's almost as though I think there was a period where very recently that the resources index was getting absolutely hammered. And I said to myself, this is people throwing in the towel now, and this is probably the time to start picking up. It's not going to be a V-shaped recovery, but it's going to make a nice sort of saucer base, and over the next few years go. And as you say, Glencore doing well. I need to go to number 4 now. Capitec Bank Holdings Limited. It's probably gone up to number 2 since you published this, because of the amount that the share price has gone up. So it's probably raised itself in your log table.
No, it's actually been the opposite. We bought substantial positions in Capitec last year. Within Capitec is a fantastic business. And in the middle of all that fear around Able, August last year, when Capitec gets a double downgrade from Fitch, for us that's the opportunity to buy a fantastic business at a great price. So it was a substantial part of our portfolios, and we've actually been reducing because the share price has done as well as it has. And again, the margin of safety has diminished substantially. I mean, it's done incredibly well.
So you're applying the sort of Naspers theory here to Capitec. I mean, it's a fantastic business, it's got great management, and it will continue to do well over the years, but it's just too rich for you.
That's exactly right. So we require a margin of safety, and we don't want to own stocks that are potentially overpriced.
Imperial is an interesting one because of logistics. I don't know, logistics has also been it's sort of a 50-50 play. Some people hate logistics, some people love it, some people say, well, the fuel price is going to help, other people say the rand is not going to help. This is one you like?
Yeah, Imperial would be kind of a bread and butter opportunity for us. There's a lot of fear around, particularly their vehicle import business. And we view those kind of fears as what we need to invest in a high quality business at a great price. And we think Imperial is a business that generates fantastic cash flows and far ahead of the market returns on equity through the cycle. You can't buy those businesses cheaply every day. We think this is the kind of environment in which you can, and we think it's a fantastic opportunity.
I have to talk about Steinhoff. We've spoken about Capitec. I have to talk about another proudly Cape Townian company, Steinhoff. And then again, another success story. It seems to go up a level, stabilise a bit, and then go up another level. It's been doing that recently. Do you still like this one? Have you been reducing?
Similar to Capitec, we've been reducing substantially. For a number of years, Steinhoff was our largest holding. It was a very tough sell 2 years ago. I mean, we got a lot of flack from investors and potential investors. And
when it was 15 to 20 rand a share, probably.
It was low 20s in May 2 years ago, trading at less than book value and around 7 times earnings. It now trades on 16 times earnings. So the whole sentiment around the stock has changed. And again, Steinhoff's the kind of company we would gravitate towards, where we've done a lot of research that indicates to us this is an above average quality business. We think they've got an exceptional business in Europe, and yet we're getting it at this massive margin of safety. So we're high conviction view of ours. Unfortunately, price relative to value, that gap has closed, so we've reduced our position, but still a company that we think has a very strong long-term opportunity.
So in the low 20s becomes 76, 77 rand at the moment. 15.95 is the PE ratio. Is that the first thing you look at when you say, oh, we love Steinhoff, we love the management, we love Mr. Jooste, and but unfortunately it's just too expensive?
PE is one thing.
Is that the first thing or the second?
Again, the first thing we would typically look at is try and look at the quality of the business. We try to find companies that we want to own for long periods of time and then assess how much we're paying. So we capture that in what we refer to as our 3 M's, and 2 of the M's being moat and management speak to the competitive advantage of a business and the quality of the management team. And these fantastic businesses where we think we can tick those 2 boxes, we're happy to pay up a bit. And if we can buy those kind of companies at a substantial discount to what we think they're worth, we tend to swing quite hard. And Steinhoff was exactly a case like that. So the price would be the 3rd consideration, but the first thing we're looking at, and in substantial detail, is trying to assess the quality of the business. Finally,
give us you've talked enthusiastically about a share called Imperial, a company called Imperial. Give us one overseas stock that you like at the moment. I noticed Cisco comes in at number 8 here.
Yeah, so Cisco we like. Cisco we think is a high quality franchise which is not being reflected in the share price. We think the types of characteristics we'd be looking at as evidence that it's an above average quality business would be free cash flow generation, return on capital, margins, returns to shareholders in the form of dividends and share buybacks, etc., etc. And in Cisco's case, we think we've got all of the above. We've got a virtually unassailable position in the areas in which they play, and they're becoming more and more relevant in those spaces. And yet it trades at a nice discount to what we think it's worth. So we expect it to compound returns for shareholders for many years to come.
I'm reading from a fact sheet, and briefly, this is my last question, that was valid until the 31st of December of last year, I think. Have you added anything in the last 3 months, the first quarter of this year?
Where we've been adding is companies where the share prices have come down. So we typically see that as a good thing. As value investors, declining share prices are a good thing. There haven't been too many of those on the market, but we've been adding to a position in Anglo Platinum, a position in Glencore, etc., etc. So it would have been in the areas of weakness, and we would have been lightening in the areas of strength. We spoke about Steinhoff, we spoke about Capitec in that context. So it's a nice problem to have, to be able to sell into strength.
It's a great problem. Shaun, thanks so much for your time this evening. That's Shaun Le Roux, who is a portfolio manager at PSG Asset Management, talking about the PSG Equity Fund.